It is 6:45 in the morning on Monday, March 23, 2026. The global financial markets are practically asleep. There are no Federal Reserve speeches on the schedule and no scheduled economic data drops from Europe or Asia. But then, an unknown trader, or possibly a coordinated group, starts moving massive amounts of money. Over the next 5 minutes, they place a staggering $580 million bet on Brent and West Texas Intermediate crude oil futures. A futures contract is a binding paper bet on what the price of an asset will be at a later date, rather than buying the physical barrels of oil. $580 million is roughly 6 times the normal trading volume for this specific asset at this exact time of day. Exactly 15 minutes after that initial influx of money begins, the clock strikes 7 a.m. sharp. The President of the United States publishes a post on social media, announcing entirely out of nowhere productive peace talks with Iran. The market reaction is violent and instantaneous. The prospect of Iranian oil flooding the global supply causes crude prices to completely crater. Meanwhile, broader equities surge on the geopolitical relief, with an additional $1.5 billion injected into S&P 500 futures right in that exact same tiny pre-market window. Whoever placed those massive futures trades just minutes prior walks away with millions in profit. This legally bulletproof extraction of wealth happened in a total vacuum of traditional news, indicating that the boundaries between executive statecraft, personal communication, and high-frequency trading have dissolved. To understand the mechanics of those 2026 oil trades, we have to look backward to the first presidential term. Executive influence over the stock market is a rigorously tested, mathematically proven academic phenomenon. This chart visualizes the mathematical baseline of that influence. Event studies from universities in Richmond and Sweden tracked the president's social media posts between 2016 and 2020. They found that when he posted about a specific publicly traded company, it caused abnormal stock returns of exactly 0.25% by the end of that exact same trading day, moving precisely in the direction of the post's sentiment. The initial price movement is only the surface level. These posts also caused a massive 19% spike in structural volatility. The erratic shakiness and total unpredictability of a stock's price would operate like a lingering hangover for up to 4 full days after a single post. Institutional players on Wall Street built mathematical models to measure this chaos. JP Morgan scraped the data and identified 78 specific trigger words in the president's posts. Words like China, billion, and tariffs that correlated directly with instant spikes in the stock market's primary fear gauge. By identifying those trigger words, analysts highlighted a permanent feature of the market called jump risk. A jump is an instant, violent discontinuity in the price of an asset. It makes it nearly impossible for an everyday retail investor to predict or buy insurance against a sudden 4% portfolio drop that happens in a literal millisecond. Academic consensus leans toward this early market influence being an accidental byproduct of an unfiltered communication style. The traditional filter of the White House press office was removed, allowing a stream of consciousness approach to reach the market directly. 4 years of predictable market ripples successfully conditioned high-frequency algorithmic trading systems. These bots now automatically execute millions of dollars in trades the exact second specific trigger words hit their data feeds. That algorithmic conditioning laid the groundwork for a highly deliberate strategy when the second term kicked off. In April 2025, the administration rolled out the Liberation Day tariffs, weaponizing market chaos as a tool of coercive statecraft against the European Union and China. This chart breaks down a sequence of coercive diplomacy that analysts dubbed the taco strategy. Step 1 imposes a shockingly tight deadline and an extreme threat, like 145% punitive tariffs, designed to suffocate a trading partner's economy.
Step 2 is the holding pattern. The administration maintains the threat and waits for the counterparty to feel the economic pain, forcing them to publicly acknowledge U.S. leverage. Step 3 occurs once they concede. The administration suddenly reverses the policy, framing it as a diplomatic victory. On April 9, 2025, right in the middle of an engineered market plunge, the president posted, "This is a great time to buy DJT," his own media company stock ticker. 4 hours later, he officially announces a 90-day pause on the massive tariffs, and the S&P 500 instantly surges 9.5% by the close of the day. Advising the public to buy your own stock exactly 4 hours before you reverse a massive trade policy creates a massive conflict of interest. However, under U.S. securities law, specifically Rule 10b-5, the absolute cornerstone of market manipulation is deception. To be convicted, you have to spread provably false information to artificially inflate or depress an asset's price. The administration did not lie. They legally imposed the tariffs, and then they legally paused them. Because the administration openly announced these policy shifts, the actions were not legally deceptive. Furthermore, insider trading requires sharing non-public information with a private group. Because the stock tip was broadcast publicly to 9.4 million followers, the information legally belonged to the public the second he hit send. To ensure these actions went unchallenged, the administration fired several independent inspectors general, removing the internal watchdog system. Concurrently, the SEC experienced a massive exodus of veteran staff and a 27% drop in enforcement actions, systematically pivoting away from complex, high-level market manipulation cases. By utilizing public communication and actual documented policy mechanisms, the administration engineered a system where crashing and spiking global markets is categorized as aggressive executive governance. Under current U.S. law, these actions are legal. Once we understand that these actions exist in a vast legal gray area, that $580 million oil trade from 2026 takes on a calculated context. Financial researchers propose we are looking at a deliberate, six-step macroeconomic master plan, rather than just a localized scheme for opportunistic profits. Step 1 requires the United States to achieve absolute dominance in the global oil supply. Step 2 takes that massive supply and weaponizes it. By combining record domestic production with sudden diplomatic announcements, like the Iran peace talks, the administration actively forces global oil prices downward. Driving energy prices down acts as a massive stimulus for the broader economy. Artificial intelligence development requires energy-devouring data centers that pull gigawatts of power off the grid. If oil and energy costs crater, the profit margins for U.S. tech and AI giants expand rapidly, allowing them to scale at a pace that traditional energy costs would normally prohibit. This artificial tech boom is designed to drive the national gross domestic product to record highs. When the total economy expands faster than the interest on $39 trillion in debt, the debt burden effectively shrinks relative to the size of the country. It is a mathematical strategy to outgrow a bankruptcy by using cheap energy as a fuel for the tech sector.